You should be able to see the website of the financial forecast at this moment. Okay, everything is working okay. Perfect. So I think we have around 45 minutes for the webinar of today. So let's get started then. Let me organize the windows a little. So we should have, you should have a chat box. Please, any question that you have today along the webinar, let me know and drop it in the chat box. It's a quite interesting subject that we have for today, and it can open the possibility to ask many questions, especially because it's something that you cannot find a lot of bibliography and information in the websites and books. So that's why I think it's quite interesting for you to start understanding how the automations work and how to evaluate and build and evaluate an automation from your side. Okay, good. So I will move to the presentation. Okay, let's start with the webinar from today. Welcome everyone. Today we have a special webinar because we will be talking about automations, but not any kind of automation. We will be talking about an automation based on Elliott Waves and Fractals. So we have a brief intro that we will try to skip it so we can focus these 45 minutes that we have in the complete subject, and also open to you to make the questions you need. We will deep dive into the top guidelines to identify waves. There is a lot of subjectivity around this because if we follow the Elliott Wave principle as it is, with the same graphic, we can give to 10 different analysts the same graphic and probably we will get 10 different counts. Yeah, that is because of the subjectivity around Elliott waves. And this is because the rules to identify waves are not complete. And we base all these rules on lengths, the lengths of waves, but we forget about an important piece of all this big picture, that is the time that is connecting the different waves. Then we will see 10 different iterations from a simple pattern that is a zigzag. How this zigzag can build in 10 different ways is quite crazy, no? But we have just a simple zigzag, and based on how this zigzag constructs and how the sentiment of the different investors create that iteration, is going to give us at least 10 different basic patterns that we will use to identify a zigzag. After that, we will check what are the top indicators to determine two very important aspects on the personality of the waves, that are the trend and the volatility. As we are talking about building a strategy, a very important piece of this strategy are the money management rules. If we don't have clear and good money management rules, then probably if we have a successful strategy in terms of identifying waves, in terms of entry and take profit, but if we don't have these rules clear and healthy rules, probably that successful strategy can become unsuccessful. So that is why it's very important to set clear rules for money management. At the end, the final step is the optimization. How we should really focus properly the optimization process, because we can fit an equity curve using different levers, and in that piece of that period of time, our strategy can be extremely successful. But then when we start testing or rolling live that strategy, we have totally the opposite of what we got in that equity curve during the optimization and successful strategy. There is a reason why this is happening. Okay, so 40 minutes, a lot of things to talk about. Feel free to comment and to make questions. Hi, Brian. Brian saying hello from the chat box. So let's start with this. Before we start, sorry. If you want the PDF from today's presentation, you can get it for free, of course, and you need to send an email to info@thefinancialforecast.com. At the end of the webinar, we will see that all the theoretical principles that we will discover today, or I will show you today, are the base foundation for a strategy builder that we have. Yeah, an expert advisor that allows you to build multiple different strategies. Okay, and you can download it at the website of thefinancialforecast.com. And then if you have questions after the webinar, of course, you can send me an email to info@thefinancialforecast.com. And also, if you want to have a conversation one-on-one, 20 minutes for free, you also can do it, and you only need to book your seat. Okay, let's skip the intro. Important thing, we will analyze and we will understand financial markets as fractals. Yeah, that's the backbone of everything I'm doing on all my research and everything we are doing at the Financial Forecast. Why is it's a fractal? Because it's representing, can show the social interaction that arise from the economical activity. Yes, and that those emotions, that panic and optimism, it fluctuates, and you can see it in the different graphics in different financial markets. And what we will do with this automation, with this strategy builder at the end, is to identify those patterns that repeat, just to get the edge and invest in the future. Elliott Waves. Elliott Waves were described in 1930s by Ralph Nelson Elliott, but it's almost 100 years old. But in any case, despite that this is a very old principle and it's based on the Dow Jones average movements, we have key elements of this principle that are describing how the fractal behaves. So we will take those and we will skip all the other ones that create a lot of subjectivity and an inaccuracy in how we are going to identify the waves and how we are going to use those waves in order to invest in the different financial markets. Basic rules. This is important to know how they work. 4 rules that will allow you to identify the first 5 waves within the Elliott wave pattern. The first wave, this is important also not only to identify the 5-3 pattern that Elliott described, but also the zigzag, yeah, some of them. So the first rule, the wave 2 must not exceed the start of the wave 1. That is really, really important. In case that the wave 2 breaks the beginning of the wave 1, then that wave is not a wave 2. And we are in front of a different kind of pattern. That's why we should be adjusting the counting and the labeling for that pattern. The second rule is the wave 3 is never the shortest wave of 1, 3, and 5. So Elliott mentioned 2 different kind of waves, the motive waves and the corrective waves. These waves 1, 3, and 5 are the motive waves. Why? Because they move in the direction of the main trend. And those corrective ones are those that are moving in the opposite direction of the main trend. So the wave 3, that is the wave in the middle position. So if we see in this graphic, we have wave 1, wave 2, wave 3, 4, and 5. The wave 3 cannot be the shortest of wave 1 and 5. If we see this, then that wave is not a wave 3, and we need to change the labeling for that counting. The wave 4 never enters the territory of wave 1. That is what we call overlap. That means that the wave in the position 4 is not entering the territory of wave 1. Yes, that means the length defined by the beginning and the end of this wave. If the wave 4 enter, then it's not a wave 4. Okay, you will find a lot of exceptions to this, specifically to this rule, but the general rule says that it's not a wave 4. By instance, then you need to change the labeling because it's not a 1, 2, 3, 4, 5 pattern. And the last rule is that the wave 2 is never a triangle. And for Elliott, the triangles have 5 waves, 5 internal waves that are creating the triangle pattern. Okay, so wave 2 is never a triangle because Elliott identified triangles as the preceding pattern to the last motive wave. So that means that we see a triangle, then we will see another, in this case, movement to the upside, if we're talking about a bullish pattern, but then we will see a reversal and a correction of a higher degree. Any question by far? Good. So from these rules are nice to apply and to learn how to identify waves, but we won't take them all, yeah, to build our pattern. But also, Elliott identified this zigzag pattern, these 3 waves. And these 3 waves can repeat up to 3 times, creating something similar to the pattern we saw before, a 5. Bear in mind that Elliott described and worked in this principle in 1930 with daily graphics, mainly. So I didn't have the chance that we have today to go so deeper in the graphics and the different movements that we can see from the different instruments. That is why when we try to apply this 5-3 rule at any time frame, we will find gaps and we won't succeed on identifying this 5-3 model, except we break some rules, we do some adjustments, and we try to fit those 5 waves into the graphic and not in a nice way. That's what happened with most of Elliott Waves countings. Yeah, for those that follow the purist Elliott wave principle. But this exact pattern is quite good because it will solve in the end what I mentioned before. We can have up to 3 times this zigzag, even more. We can find it more, but 3 is the maximum, let's say, that we can identify, and all those zigzags are connected by a wave called X and also a connector. That means that we will have a zigzag, in this case labeled as ABC, a connector that is also zigzag with X, then another zigzag ABC, another connector, and then another zigzag ABC. So that structure that we saw is a very important structure because we will use that in order to identify and to create the different iterations for the simple zigzag. Another big discovery was the usage of Fibonacci sequence within the analysis of waves. Yeah, we can. Fibonacci sequence is present of most of nature elements, and also it creates. We can see a balance and a perfection into it. That's why we see this a lot in the nature. We can see it, for example, related to the weather and how the wind moves from the different areas. That is also is used, is the study of this movement of the wind use a fractal principle that I will mention later. But it's very important to use this because waves used to connect through this sequence and through this ratio, the Fibonacci ratio. So that means that wave A and B can be connected by the retracement and how much that corrective wave is retracing the wave A. And most of the time, let's not say always, it's not never is always, but yes, most of the time, those retracements used to finish between the area of 0.382 and 0.618 retracement of the prior motive wave. And also, motive waves are connected by that Fibonacci ratio, by length. If we project then the length of the wave A from the end of the wave B, we will find out that most of the waves used to finish between these areas also, 0.618, 0.854, 1, 1236, 1.618, and so on. But mainly, and we'll see later, there is a condition that we can identify also, that the extensions used to be around the 0.618 and the equal waves. That is the relationship of 1. And also this rule, this is so important because we see this repeating constantly in financial markets. And now that everybody is with panic about the inflation recession and is trying to look back in time to try to identify exactly the same pattern in the past to repeat now nowadays. And this rule is exactly saying that it won't happen as the same. So that pattern will change. So that's why when we are trying to connect and just looking at the back and saying, okay, I want to see the same pictures now, it's most likely that that won't happen. Why? Because of this alternation rule. I call it a golden rule because in the end it's saying that it's establishing the expectancy of differences between similar waves in length, time, speed, and construction, especially that piece of construction. So that means if we have a first motive wave that is simple, then we have more chances to see the next motive wave, that in this case is a wave 3, with a complex setup instead of simple. Yeah. That doesn't mean that simple is not going to happen. It's most likely not going to happen because we will react. We will reflect our emotions in a different way. And the same for the last wave. If the prior two were simple and complex, probably we have more chances to see the last wave as more complex. That's when we see very choppy and overlapped waves. And that used to happen in the fifth position. But also this happened with the corrections. If we have a sharp correction in the first term, probably this next correction is not going to be sharp. It's going to be more shallow and more complex. It will take maybe more time. That is very important, especially nowadays when we are trying to see if we are going to enter in a big crash, if Bitcoin is going to disappear, how deep is going to be the correction. And we are all the time looking back to trying to connect that piece and find the unique and true answer. And when the big mass of investors are doing exactly the same, everybody's trying to find out the answer using the same rules, the same tools. Most likely that is not going to happen. Okay, that is the alternation. All those rules are the ones we are going to take from Elliott to apply in the logic of our strategy builder. But also we will move to 1980s. 1980s is when the definition of fractals appears. Fractals were described in the past, but not with the name of fractals. They didn't have a name, but they were there, present all the time. And in 1980s, this person called Mandelbrot defined the set of fractals and also describe the properties that they have. And fractals are simple, simple forms that repeats in order to create bigger and more complex uh, uh, patterns or forms, and is mainly present in nature. We have several examples of this. But for example, if we go to the broccoli, everybody has, or most of the people have a common broccoli. So if we see the broccoli, then we will understand better how this concept of fractals, what is this about a fractal? That doesn't matter where are we taking this broccoli, from which piece. See, if from the big branch or from the smaller ones, we will tend to see all the time the same or a very similar shape. But everything starts with a very simple one, that is the initiator. And the initiator in this case is a straight line, no more than that. We are talking about the pattern that we can find in financial markets. From this initiator, we can create the generator. That in this case is the zigzag. It's just a simple zigzag. We arrange this this line, and this generator will repeat, will iterate in different ways to create the bigger picture. And this concept of fractal will tell us that doesn't matter what is the scale that we are watching at this, we will tend to see all the time the same. If we do that, we take the generator and we iterate the generator only using price. That means we will iterate the length of these waves all the time. The final picture we get doesn't look like to a financial market. Yeah, it's the image we have in the middle of the slide. This doesn't look like a financial market at all. And the problem is that we forgot for many years the time. Time is very important because it's also a way that we manifest our emotions. We can react quickly or we can react very slowly. We need some time to digest what happened, or we want to act fast. So that creates change in the speed of the waves. That's why financial markets are multifractals, because we have the iteration not only of price, but yes, also the time. And this is something that we can see when we talk about volatility. When volatility increases, it's because we are moving faster. In the graphic at the bottom, so we have the zigzag, the generator, and if we move faster, we iterate the time, and we move to the left. That means an increase in the volatility, and for that instance, the price will reach what I call the attractor, the target area, faster, and if we keep the balance of the equilibrium between price and time. And then the corrective wave can go slower than a normal correct or a regular corrective wave. Yes, just to try to find that balance between price and time. But if we deplace the wave to the right side, so that means that we are moving slowly. We are decreasing in volatility. It's taking more time to reach that area, that target area, and in consequence, we have that decrease in volatility. But also, this means that this can be observed quite many times when we have this kind of waves that are very slow, very choppy, very overlapped. then the corrective wave is to be very fast and sharp. Yeah, it's a consequence of this, of finding that balance between motive and corrective wave. And this iteration in time also follows the Fibonacci sequence, and in this chart, you have a nice example in the pound dollar. This is a 4-hour time frame, how all the waves are connected in a different degree. Yes, so the bigger waves are connected in length and time through the Fibonacci ratio. And the same happened with smaller waves, smaller degree waves. Yes, it's very important. That give us a very important insight on how we behave when we need to make decisions about investing and trading. And every instrument will manifest, will show different patterns and different relationships. What we will show now, they are like the standard relationships, standard rules, but it will change depending on the pattern, okay? But it's very nice to see how everything is connected around 1, 1.5, 0.382, 0.5, all these connections in time. That's why we can say that the time is not random. In this figure, motive wave and corrective waves tend to length time speed equilibrium. That's really, really important to understand. And this breaks then the way that we are using currently Elliott waves, because we tend to force to fit a 5-way counting, breaking this natural rule of connection between length and time. And before I was talking about a very simple rule. So we have in a zigzag pattern, the third wave, the wave Y, will be conditioned by the prior two waves, the wave W and the wave X. And this is present in my book. So if we see that the correction of wave X finish around the 0.382 or 0.5 retracement of wave W, prior motive wave, then we have more chances to see the end of the wave Y around the 0.5, 0.618 extension of wave W. Yes, and the same, something similar will happen if we have a deeper correction between 0.5, 0.618, then we have more chances to see the end of wave Y in the equal waves area between the 0.854 and 1.236. Try at home, try analyzing manually your graphics, and you will see that this is happening most of the time. But that gives you a very important insight on when it's best to take profit of the trade or the investment that you are doing based on this relationship. Everything is clear until here. We have around 15-20 minutes. Okay, no questions there. I'm happy. So that means everything is clear. So we will move then to the different iterations of the zigzag. We saw how the pattern looks like, just a simple zigzag, 3 lines. But this alternation rule allows us to create more than 10 different iterations. I'm using 10 for this strategy builder, but we can build more and more. Starting from a very, very, very simple zigzag where W and X are completely simple, to very, very, very complex waves. When the corrective wave, for example, can take up to 8 different waves to get built. So we go from a simple iteration, then we go to more complex, where the motive wave, in this case, you can see the subdivision in 3 waves, and then you have a deep corrective wave X, finishing in one of these two, these prior waves of the lower degree. Then we have also a complex zigzag for the motive wave, but a simple and a more shallow correction for the wave X. Then we have a very deep correction for wave X, the same construction of zigzag, but if you look here, the first wave is bigger than the prior one. Yes, we can see a bigger size. Also, we can keep the first wave motive wave simple, but the correction can be complex. This will take a lot of time, and we will see this mainly in those shallow corrections. And also we can see the shape of a triangle. In this case, we don't see the complete triangle, but yes, we see the beginning of a triangle construction or a complex next Y wave. Then we have both a structure complex, the motive wave and also the corrective wave, where you can see perfectly well the subdivisions in three waves. And this is my favorite pattern. You can find this quite often in the financial market, different instruments. And the strategy that we have working at copy trading is using mainly this pattern. This is a 5-way pattern, as Elliott mentioned before, in the principle back then in 1930s, where the first wave is simple, the second wave is complex. Yes, within this wave W is what I call simple complex motive wave, but then the corrective wave is simple. Yeah, it's very, very important to describe this. High complexity is a very simple wave X, and this is very similar to the 5-way pattern that Elliott described in 1930s. And this pattern works really well. It's not that we see 5 waves structure as Elliott mentioned, but yes, a different iteration of a zigzag from simple to complex. And this pattern really repeats quite often in the different instruments with high accuracy on it. And then we go to the most complex iterations. So we have the similar wave W, simple complex, and we have a complex wave X, where we can see the different subdivisions. And then we have a very, very complex corrective wave. We have a total of 1, 2, 3, 4, 5 different waves building up, constructing this corrective wave X. All these 10 iterations, we create the logic and we put them inside the strategy builder, the Bumblebee. But also it's very important not only check the structure by itself. We need more insight. We need to define as much as we can the sentiment of the investors within that pattern. That's why we will use 3 elements, 3 pillars that will describe completely that behavior of the pattern, how the pattern looks like. So we will use trend as the direction of the motive wave. We'll use persistence as the fact of continuing the trend. This is coming from the fractal theory. Volatility, we will talk about the size of changes. And we have a set really big of different indicators that will allow us to choose that one that fits better for the instrument that we are building up that strategy. So for trend, for example, we have the price and the moving average. We have 2 moving average if we want this a slower reaction. We have pivot points and we have the MAC. Then for persistence, we have the FDI, that is a fractal dimension indicator. And for volatility, we can use Bollinger Bands or the ATR or the spectrum indicator, that is a proprietary indicator we have in the financial forecast, and also the stochastic. Yes, we will use these ones to complete the picture of that pattern. Then we move to the money management rules. We said before, it's very important to define them properly because we can convert a successful strategy into unsuccessful strategy. That's because a bad money management rule applies. So what we will use, and this is for our copy trading strategy also, the risk per position between 1 2% and even less than 1%. Yeah, but no more than 2%. It's not healthy to do that, even if we think we found a very accurate and successful strategy, because that doesn't mean that if worked perfectly in the past will work perfectly in the future. And then when you can get your first hit against the wall and and lose a big part of your investment capital with this with a strategy that was not correctly set with the money management rules. The stop loss, always we need a stop loss and need to be clearly defined. For this we will use Elliott Wave principle. We will use the beginning of the motive wave and at the end of the corrective wave, depending on different situations. But the stop loss will be clear defined using this. And because we know that at the moment that the corrective wave breaks, for example, the beginning of the motive wave 10, that pattern is not the pattern that we thought it was. So we need to stop that position as soon as we can. The same if we are moving forward and we think we are in a pattern, but it's not. The break of the end of the corrective wave, in this case X, will also give us that red light to say, okay, this is not the pattern you thought it was. Also important to have a take profit clearly defined. Stop loss and take profit are very important. We cannot keep a position open for ages because probably, especially if we're talking about Forex market, it will turn and you will get the position close at zero if you're at break even or with losses, just because we were too ambitious with the take profit level. That's why we need to use the rules we saw before, depending on retracement levels, 0.618, equal waves, an extension that mainly is 1.618. Those are healthy levels with high occurrency. If not, we will expecting for something that probably it won't happen. We need to be very careful with that. Then we need to choose between symmetric or asymmetric leverage. So you can use both in this case. It won't affect highly if your strategy will be successful or not. But yes, the way you will move forward with this strategy and how difficult it will be to recover lost positions. And this is how you have in the graphic that is reflecting exactly that. How in an asymmetric leverage is more difficult to move forward recovering lost positions, but with a symmetric strategy, symmetric leverage, then we are talking about all the time the same. And this is very important. Never follow a martingale strategy. Never. It's proven it's too risky and doesn't work 100% of the time. Yeah, because you need for a martingale to work well an infinite working capital. That is not the case. We always have a limit for our investment capital. So martingale, and we need to think always the market moves in 3 different directions, doesn't move in 2 as most of people think. It's not up and down, it's up, down, and sideways. Yes, like when we go to the casino, it's not black and red only. It's black, red, and green because we have the 0. And that breaks that balance in the use of the martingale. We put all this together, and then is what we have. We create this strategy builder that is called the Bumblebee, combining Elliott Waves, combining fractals, taking this different indicator for trend volatility and persistence. And with that, using MT4, we could start designing different strategies for different instruments based on this Elliott Wave principle. You can find this expert advisor in our website, thefinancialforecast.com. It can be used in any kind of instrument. We have it working with Forex, gold, and now we will soon have the strategy for Bitcoin. The advantage of this is you can create an alternate strategy. That means that you can go bullish or bearish. You can really follow the trend despite what is the long-term main trend. So in this case, we have the S&P, we have crypto just falling in a situation of crash, uncertainty. So that doesn't mean that you cannot get advantage of the market. That doesn't mean that you cannot read the patterns behind. This strategy builder allows us exactly to read also bullish, but also bearish patterns and act depending on that. And then when we need to move to the optimization process. I say here, I put it here, keep it simple. This is very, very important. The more complex that the optimization is, the worse your pattern will work. Because you are over optimizing just to fit your equity curve. And that shouldn't be happening. First step and first advice I give to those that are using this strategy builder is find a raw pattern, just a structure, simple, plain, that is already successful in the market. And you will find from those 10 iterations, one that's going to be, at least one that's going to be successful with that instrument. In this case, we are showing an example with the pound dollar. And this is a pattern, that one I said before, it was my favorite, with a total of 5 internal waves for the motive wave and a simple correction. And here you can see we have a successful raw pattern, just very simple. And with that, we can start working on it and optimizing. And the optimizing process goes as follows, as is described here. First of all, we need to define the money management strategy. Yeah. Once we have that, we need to select the trading time. That's very important. We want to trade only London. We want to trade London, New York. We want to trade 24 hours, 7 days a week, only Monday to Friday, only Wednesdays. So we can choose that, but we need to select that trading time. Once we have that, we need to scan all the different patterns. We said before, we have 10 different iterations. So what we need to do is just find those iterations that fit best for that instrument. Because what we want to do is find out how the motions of the different investors are manifest in that graphic. Then when we start with the fine-tune optimizing, because we want to find what are the best length and time relationships, connections between motive and corrective wave. Yeah, so we started with this one, just a simple pattern. We find out the best trading time is this one. Then we define the best length and time connections. Just look like how the pattern gets more and more effective, more and more accurate. Yes, with a very simple optimization. And not the last step, but one important step is when we want to define, we have now this length and time connection defined, as we saw before. That's really important to build that fractal in financial markets. We take the picture, we need to find out what is the best persistence, strength, and volatility for that pattern. And for this is when we can make mistakes, mainly because we can overfit, we can use a lot of indicators. Recommendation is only use one for each, one for persistence, one for trend, and one for volatility. And always try to skip all the extremes, those where most of the errors are going to happen. Yes. No go so deep. Just keep it simple. Remove, for example, if we're using Bollinger Bands, we know that more than 70% of the time, the price will be within the Bollinger Bands. So we will use standard deviation too. If we want to capture most of the range of prices, then we use standard deviation 3. But don't go so deep just to try to fit your equity curve. Yeah, don't use all the different indicators that you have in the tool to define volatility or to define trend. Just use one, the best that fits best for your instrument, the one you're building the strategy. And a very important piece, the last one, most of people forget about this. We need to try our strategy in a period of time where we didn't try it before, where we didn't work with the optimization process. And this is what we see in the last graphic. So we see a piece that was tested without optimization, and we can see a continuation of the equity curve. So that gives you more certainty about the accuracy of your pattern. Yes, so then you can put it live and you can check how it works. But this gives you more insight that you are in front, you created a successful strategy. When we check the statistics, so we have a profit factor of 3.26. It's really high a profit factor. We have a drawdown of 1.71% for the strategy created. And then we have accuracy of 87.7% for both pieces, the optimized and the non-optimized piece. Total of 15 consecutive losses, the maximal, and 16, and 2 losses. Okay, with this, we can create now easily an automated strategy based on Elliott Waves and Fractals, thanks to the development of this tool that is containing years of research from my side, and it give us a chance to give a nice product, for example, copy trading, or for you if you want just to create your own strategy. And here we have some different examples of different equity curves that we have for different instruments. We combine all of them together, and that give us what is the statistic for the master portfolio we are working with, profit factor of 3.4, a drawdown of 2.4%, 87% accuracy, Sharpe ratio of 3.22. It's really, really good, and it also passed the Monte Carlo test, so everything is working quite okay. And I will show you to finish this webinar. I will open to questions. A set of random strategies also created with this tool. So here is a live test was rolled out during March. We have different instruments set with simple strategies. We have the pound, we have the US dollar, we have the Euro GBP, Euro dollar, US CAD, US Swiss franc. So many of them, simple strategies. And this is what we got during the live test. Really excellent results. We have a profit factor of 5.04 and accuracy of 85%. Really, really good using this tool that is the Bumblebee Strategy Builder. And with that, we have finished the webinar. For those that you want to check more, it's in thefinancialforecast.com. You can go to, in this case, indicators, where you are going to find the strategy builder. If not, you can send me an email to info@thefinancialforecast.com. Thank you all. I hope you found this webinar useful, and anything you need, you know where to find me. I hope to see you soon in the next webinar. Thank you.